$100 per week into SCHD today will make you achieve a happy retirement. So it's payday. Still, something doesn't sit quite right. It feels like you don't have enough money to kick back and enjoy life. Ever wondered what that would be like when you eventually retire? Don't panic just yet, because you actually don't need millions in investments to set yourself up for a happy retirement. Today, we will be sharing how investing just $100 a week can make you achieve a happy life after retirement. By snowball effect, I will show you how putting $100 a week into SCHD can grow into a portfolio value of over $2.2 million. By the time of retirement, I will show you how $100 a week can help you achieve an annual dividend income of $170,000, or translate to more than $14,000 a month, which you can live on comfortably. So what is SCHD? SCHD stands for Schwab U.S. Dividend Equity ETF. Launched in 2011, the fund, sponsored by Charles Schwab, has since amassed assets worth over $67.5 billion. This makes it the largest ETF as it attempts to match the large cap value segment of the U.S. equity market. Being the largest is great, but it is also one of the most popular dividend-focused ETFs available. We aren't going to assume everyone knows what these are. We mean, you could be new to investing and just trying to figure out the best path for you. So, we will make this easy. To begin with, ETFs, or exchange-traded funds, are like baskets of investments. Just imagine a basket filled with lots of different things, from stocks to bonds or other assets. So basically, when you buy an ETF, you're buying a little piece of everything in that basket. Now that you understand the basic idea behind ETFs, let's get back to SCHD. This can get a little technical, so we will break it down in such a way that even a toddler can understand. Just think of SCHD as a money tree. Like regular trees, SCHD is bound to grow money fruits. So for every time you plant a seed, the tree grows a little bigger. The seeds here are, of course, your money. The more money you throw in, the more fruits you get in return. Now, this isn't just any tree. It's special. Unlike other ETFs, SCHD only picks the strongest and healthiest of trees to grow in its orchard. So, it is almost guaranteed that these trees won't stay the same size. They grow bigger and stronger every year, which means more money for you. And it only gets better with time. If you don't eat all the fruits right away, you can plant them back into the ground. It becomes an endless loop. These new seeds grow new trees, which make even more money fruits. It's a neat trick called compounding, but we will get into that in a moment. The more seeds you plant and the longer you wait, the more trees and fruits you'll have in your money orchard. Thanks to SCHD, you can become a smart gardener who takes care of his orchard and will have lots of money when you need them. Now, let's toss the analogies aside. One thing you can bank on when it comes to SCHD is its sole focus on U.S. companies that have a strong history of paying dividends. And that's only one reason to consider SCHD. For the next couple of minutes, we will give you all the reasons why SCHD should be on your investing radar. The ETF invests in high-quality companies with strong financial health and solid performance histories, with an aim to reduce risk. Moving on, SCHD offers a diverse portfolio. It provides exposure to a variety of industries, which helps spread risk while focusing on dividend-paying stocks. Then, of course, there's the increased potential for growth. Many of the companies in SCHD offer the chance for capital appreciation alongside dividend income. Lastly, and a popular favorite, is convenience. SCHD presents a simple, hands-off way to invest in a curated selection of dividend-focused stocks without taking time out to pick individual companies. At this point, you are probably thinking, why not put in the actual work? How does SCHD decide which companies are strong or financially healthy? This brings us to the simple yet highly efficient selection process of SCHD. To begin with, SCHD follows the Dow Jones U.S. Dividend 100 Index. What you really need to know is that this index ranks companies based on their dividend yield, dividend growth, and financial health. Now, let's get down to these key criteria. First of which is dividend history and sustainability. SCHD prioritizes companies with a consistent history of paying and growing dividends for at least 10 consecutive years. This track record indicates financial strength and reliability. For sustainability, SCHD avoids companies with unsustainably high dividend yields. Might not sound like it, but high dividend yields sometimes signal financial distress. Second is dividend growth. SCHD was basically designed to provide growing dividends over time as their businesses grow. Lastly, we have financial health. We will take this from two angles, for market cap and liquidity. SCHD typically invests in large cap, well-established companies that are leaders in their industries. Equally important is the fundamental metrics. The fund evaluates companies based on financial health metrics, like return on equity, debt-to-equity ratio, and free cash flow to debt. That's it. You can see that by emphasizing quality over high yields and focusing on financial fundamentals, SCHD constructs a portfolio of stable, growth-oriented companies capable of delivering consistent returns over time. Holding in SCHD? SCHD's portfolio includes notable companies from diverse industries, and several of its top holdings have shown strong performance in 2024. One of those companies is Verizon, VZ. The renowned global communications technology company Verizon has demonstrated resilience by maintaining its 17-year streak of increasing dividends as one of SCHD's holdings. Next, Texas Instruments, TXN. This leading analog chip maker represents 3.74% of SCHD's portfolio. Despite slower growth earlier in 2024, its stock price is up 23% from a low, and its 3% dividend yield remains solid. Home Depot, HD. This multinational home improvement retail corporation makes up 4.4% of SCHD and has rebounded 36% from prior lows. This rebound is supported by sustained demand in the housing market. The company offers a 2.8% dividend yield, which it has increased for 24 consecutive years. Now, these are just a few. It is a long list of reputable companies like Pfizer, BlackRock, Coca-Cola, and so on. The point is, these companies exemplify the focus of SCHD on financially strong firms with a consistent record of dividend growth. Historical performance of SCHD? To highlight its historical performance, let's compare it with a broader index, like the S&P 500. When it comes to performance, SCHD has fallen a little short. Over the past 10 years, the S&P 500 has provided a price return of around 200%, while SCHD has only returned 120% over the same period. But hold on. While it is not as high as the S&P 500, SCHD offers the added benefit of a higher dividend yield. When it comes to dividend growth, SCHD has been equally impressive. Currently, the fund's dividend yield stands at around 3.38%, and its 5-year dividend growth rate, or CAGR, is 11.94%. With these numbers, you are not just receiving a healthy dividend yield, you can be sure that those dividends are also growing at a significant rate over time. While it may not offer the same level of capital appreciation as the S&P 500, SCHD still proves itself a reliable choice for long-term investors. Calculation of compounding effect. By investing $100 a week into SCHD, you can achieve a 6-figure valuation. The trick here is to consistently employ the power of compounding. By investing weekly in SCHD, you can benefit from capital appreciation while also building a growing stream of dividend income. Sure, your income grows as the companies in SCHD's portfolio grow and increase their dividends, but compounding will bring even bigger rewards. Instead of spending your dividends, you can reinvest them to buy more shares, which will, in turn, generate more dividends over time. For the moment of truth, let us show you how you can turn a $100 per week investment into a portfolio that pays over $170,000 in annual dividends. $100 doesn't seem like much, but with patience and consistency, that small amount will bear fruit in the long run. $100 per week times 52 weeks in a year amounts to $5,200. Still, doesn't seem like much until you look at the future projections. After 5 years, your portfolio will be valued at approximately $33,000. In 10 years, it'll be valued at $95,000, while your total investment at that point will stand at $52,000. At this point, you can expect the amount invested and the ending portfolio value to start increasing significantly. After 20 years, your portfolio will be valued at approximately $460,000. In 30 years, which is conveniently around the time you will retire, your portfolio will be valued at around $2,218,000, with your total investment standing at $156,000. And there's more. Remember the dividend amount we went on and on about? By the 30th year, you can expect to be paid approximately $170,000 in annual dividends. This dividend amount equates to about $14,000 in monthly income. This is how the compounding effect works. With capital appreciation, the dividend growth, and reinvested dividends, you have set yourself up for a relaxed retirement. It really is that easy. With $100 a week in SCHD, you can build a portfolio that grows steadily, providing both income and financial security for retirement. You don't need to worry about cutting back your lifestyle when the paycheck stops rolling in. Ready to kickstart your investment journey? Do share your thoughts in the comments. Like, share, and subscribe to the channel if you haven't already, and hit the notification bell so you don't miss out on future tips.